Hello, everyone. Today on the final bar, we'll talk about a market continuing to distribute. Friday saw some distribution going into the close, really a follow through much of the day today, with the S&P closing below 3430 or right about in that range. That takes it down over 1.5%, putting it back down toward that area of support that we saw around the September, early October period. So be interesting to see how we fill in that range. Also today, the 33rd anniversary of Black Monday in 1987. Ladies and gentlemen, this is the final bar. Hey everyone, welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we look at these markets together, especially on days like today where you see distribution, you see the market pulling back, you see stocks rotating from short-term positions of strength to positions of weakness. No better time to be looking at the charts. Starting at the final bar, the current price bar, looking to the left and identifying key levels really to be paying attention to. As I mentioned in the introduction, this is the 33rd anniversary of Black Monday, October 19th, 1987. So we have a really special video presentation for you in a bit, featuring some conversations I had with some prominent experts and their personal experiences with that period, the 1987 crash. A couple of them, learning the toolkit around that time. On a distribution day like today, again, it's one day among a series of days. And so the kicker is really referring back to the longer term trends and identifying how much this changes things. I think you'll find with a lot of stocks, this doesn't put anything into negative territory. It pulls them back and just sort of establishes even more so this range that we have been in and appear to be remaining in for a little while. We have some great guests coming up on this show this week. Tomorrow, on Tuesday, we have Jeff Huge from JWH Investments in Minneapolis. On Wednesday, Brian Shannon from Alpha Trends. And then on Thursday, Mark Young from Wall Street Sentiment. Thursday is a big sentiment day. I'm excited to have Mark come back. The AAII rankings really potentially turning net positive for the first time in, over 8 months probably. So it'll be interesting to hear Mark's take there. Earlier today, I was in the StockCharts studio in Redmond recording a fantastic event with for the presidential cycle, and this was featuring Tom McClellan, Bruce Frazier, and Jeff Hirsch. Sort of my wish list of 3 people to interview on that topic. They all agreed, and we had a really cool conversation, which we're very excited to share with you very, very soon. So that's today on StockCharts TV. You can see it on our YouTube channel. Let's get to our market recap. As I mentioned, today was all about distribution. Friday going into the close, we sold off a bit. And really from 3 o'clock on Eastern, and now sort of followed through much of the trading day today. Really accelerated going into the afternoon hours, but it was a broad decline really, with the S&P down 1.6%, below 3430 now. Mid caps, small caps down not quite as much, but as well the Nasdaq 100 underperformed the S&P as well. VIX back up above 29 today. In some other markets, bonds were off today, as well as the dollar. That puts 10-year yields back up around 76 basis points. Gold essentially finished flat for the day. It was up pretty big earlier, and silver as well finished net positive. They both kind of came off, almost got to the negatives. Oil was down about 1/3%, and energy led the way down, looking at sector returns. So let's look at a chart of the S&P 500. We'll come back and look at some of the sector and stock themes today. As we've talked about on Monday, really the goal is hitting the market from 3 different perspectives: top-down macro, sector rotation, bottom-up stock picking. Today we're going to focus a little bit on the macro, and then we're going to really get into stocks later in the show. So, what does this do? Again, let's keep this in proper perspective. This is one day. However, what it tells me is if you look at the trend line coming off of the September high, that was retested here in mid-September, then we broke above that in late September. That sort of confirmed this rotation off of that support range around 3,200, 3,250. We've then rotated back higher. I connected a trend line using the low from late September, the low from early October. That was tested again here the second week in October. We then broke through that, and now what it appears to be doing is testing it from below before now rotating back lower. So on that short-term sort of tactical time frame, we're certainly pulling back. Now we're sort of testing this sort of swing high. This was the peak from September. This is the first, the highs after we rotated back off of the early September low. We keyed in on this level here in early October, and now that's become essentially where we closed right today. So whether we follow through that tomorrow and into the remainder of this week would certainly validate some further short-term weakness. We're right above the 50-day moving average, which is almost exactly at 3,400. So we're really at sort of the first line in the sand. I think the second one would be this 3,350 range. That's, another short-term reversal point here from early August. If and when we would break that, 3,200 to 3,250, again, I think is the ultimate line in the sand. And I wouldn't be surprised if we pull back down into that area. Conversation earlier today on the presidential cycle panel, we talked about some, seasonal weakness going into mid-late October, which is right where we're at. But then I almost said Thursday and Friday, November and December during an election year like this usually ends up being pretty strong, regardless of who wins. It usually ends up being a pretty decent rally. So we'll see how that actually plays out. But overall, I think that would be a potential outcome. Would be a bit of a pullback before a rally into year end. But again, the trend is the trend. So let's focus on some of those key levels and what we're seeing. This pattern I'm seeing on a lot of individual stocks as well. And I think the biggest concern from a long-term perspective is I think we've now established a bit of a lower high here. We didn't validate that by breaking to new highs above 3,600, but at this point, I'm now seeing a lower high, a lower low, which would be S&P below 3,200 would validate a pretty significant topping pattern. It's a big double top pattern, but again, that's a long way to go from here. We have to get there first. Looking at some other themes today, utilities is the number one sector. I think on Friday, that was one of our 3-on-3 charts. Because the sector's actually done very well, especially on a relative basis, rotated from a negative trend to a positive trend. And just has been a strong relative performer. And today, that relative performance is going to improve, even though it's down today, not down nearly as much as the S&P, almost half the downside of the S&P today. Materials number 2, industrials number 3. These are sort of our second tier sectors we talked about last week that have emerged and continue to do well. So those 3 sectors on a relative basis that have done pretty well. They just got overshadowed by things like tech and communication services, which had sort of resumed their rally. Those 2 really at the bottom of the list, along with energy. So it was energy as the worst performer, followed by comm services, and then technology. So interesting, relative movements here with really that Utes materials and industrials trade holding up the best on a relative basis. In terms of some stocks, we're going to get to some stock things individually. I just wanted to point out airlines were the number one group today. It's actually an interesting theme. A lot of these stocks are coming out of very beaten down levels. We see Royal Caribbean and Norwegian Cruise Lines on the top 10 list as well. These are the 10 stocks that gain the most in the Scooter ranking. So if you look at Southwest Airlines, for example, it's not my favorite chart anywhere, but it's up 0.4% on a day when the S&P is down 1.5+%, regaining the 200-day moving average of that on that same time. So, an interesting combination of groups here at the top. You have some industrials, transports, airlines here. You have cruise lines, Alaska Airlines, ALK is on the top list as well, and then a smattering of other things, consumer discretionary industrials as well. Want to get on to our next segment, which is the 87 crash. So, when we were talking about how to recognize this 33rd anniversary of October 19th, 1987, Black Monday, we went back to some of the conversations we had. We'd sat down with Ralph Acampora, really walked around with him, walking around his barn in Minnesota, and we really focused on that period because it was visually a very, quite an impactful part of the tour around his barn, visualizing the Dow in life-size form. And we realized we talked about that same topic with Fred Meisner from the Fred Report when we were down in Atlanta earlier in the year. And then also we talked with Al Brooks at one of the Money Show events, and he had actually started day trading during the 1987 crash period. And so those 3 stories together ended up being a really cool representation of, I think for many of you, if you were trading, if you were investing in the 87 crash, probably some familiar stories from what they say. If you weren't around, I was not trading at that point. If this predates your investment experience, we have a lot to learn from people that have gone through some of those historical events. So here is our recognition through the lens of three different perspectives of the 1987 market crash.
I'd love for you to share the story about the 87 crash and your experience during that period. Can you tell us what that was like for you?
Yeah. In 87, I started trading several weeks before the crash. And back then, I didn't know. I didn't know what size I should be trading. I just thought, I have a lot of money. I'm an eye surgeon. I own a surgical center, and I traded heavily.
Okay.
And on the morning of the crash, I was heavily short the stock market, S&P futures, full-size S&P futures.
Got it.
And I had to go to work. I had a full schedule of patients to see, so I had to close out my short position.
Right.
And as I was driving to work, I was listening to the news to hear what the stock market was doing.
Sure.
And the news was incredible. They were saying, we don't know what the stock market price is. We just know it's down.
It's
down. There are no buyers. It's down. It's down.
Right.
And at the end of the day, they decided that the stock market was down about 20 to 25%, depending on which index you use.
Right.
And had I held onto my short positions, I would have made $400,000 on the day.
Right.
Which, in today's dollars, would have been over $1 million on a day trade.
Right.
And I decided that, maybe there's
something to this.
Yeah.
I usually ask people what a painful lesson from their trading experience. I think I already got your answer, so we don't have to go to that question next. That I feel your pain through that experience.
I'll tell you my crash of '87 story, and this is one I tell my advisor clients today.
Sure.
Because it really is, I think, instructive.
Yep.
I was trading for my manager, Larry Phillips, at Dean Witter in 1987. And right around one of my favorite days and times in history, which will never repeat again for hundreds of years, which was October 9th, 1987, at 6:54 in the morning. It was 10-9-87654. Okay? I realized that the market was going to have trouble. And I also realized that I hadn't had a vacation in 2 years. So I decided I was going to take some vacation time.
Okay.
And so I wrote a letter to our clients basically saying, I think the market is going to have problems in October. So I'm going to cut our position size enormously, and I'm going to leave. And I'm going to come back at the end of October and see what's what. So I sold everything but about 6 stocks, 6 blue chip dividend type paying stocks, and left and went on vacation. Now the first place I went on vacation, I left on October 17th, and I went to Chicago to visit the floor of the exchange. So I'm on the floor on October 19th, 1987, with a man named Larry Schneider, who was the head of Dean Witter Futures. And still, if he's alive, I'm sure he's still a friend of mine.
Yeah.
But he was older then, so he's probably not. So I'm running around on the floor of the exchange for the crash.
Wow.
Right. Incredible experience. And when I got back to my office, a lot of the clients called in and said, first of all, this guy Fred is really sharp, but why didn't you sell everything? Okay.
Right,
and the answer to that question was, I didn't think we were going to have the crash '87. I thought we were just going to have a bad market for a month or two. I didn't think it was going to be the crash of '87. But what was really interesting about that was, of the stocks that I kept, one stock went from about 55 to about 30. And then opened at 109 and went to 119 right away.
Right.
R.J. Reynolds.
Right.
The first big LBO.
Yep.
From KKR.
Yeah.
Those two things made my year. That was a huge gain on that stock. We bought that stock around 40.
Wow.
And we got rid of it at 119 because I didn't take all the junk bonds and stuff. I had my clients sell the stock and off we went.
Yeah.
And what that taught me was, if you're going to be an investor, you have to actually invest. Right?
Yep.
You can make all the trading decisions you want, but you have to actually invest.
Right.
So that's my 1987
I love
story.
that's fantastic.
Yeah.
It's really, really good.
The crash. And I think I was telling you before, for me, and after doing all this, I have different definitions for moves in the market.
Okay.
Like when you say crash, I don't know, I always used to think 50%. No, it's anything greater than 30%.
30%,
That's,
okay.
yeah, that was the infamous crash.
Wow.
And of course I had to rescale again.
Yeah.
Because had to...
Got to make room for the upside.
Yeah, but look at that. Look at, even with my chart, you can see
Yeah.
that down in that area, the Dow was around 2,000 or so, and
Right.
that was a slow but long, gradual,
and steady
wonderful
grind, right?
back up.
Yeah.
And that was the peak back in 2000 when the Dow hit
Wow.
11,000. See, so it went from 2,000 to 11,000.
So this, I mean, this stretch, I mean, how did you, I mean, the 87, you're sort of now clicking pretty well in your career. What do you tell clients, or what do you tell people when the charts look that bad that quickly? I mean, how do you deal with
Well,
that?
if you'd asked me what was my worst call, that was
Yeah.
my worst call.
Okay.
I was on the cover of Barron's magazine about 2 weeks before with a couple of guys, Bob
Okay.
Prechter, Elliott Wave.
Sure.
He was he was calling for a crash.
Pretty bearish, yeah.
A couple of other guys, Marty Zweig, who was a dear,
Sure.
dear friend of mine at the time.
Yep.
Unfortunately passed away, but Marty was also looking for, and they used the word crash. Marty was on television, and I was looking for a decline. You know, I was looking for, I did not, foresee that kind of,
Yeah.
so that was my bad call. My good call is over there.
Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. As a reminder, we love to hear from you, especially your questions that you come about as you're reviewing the markets through your own charts. Shoot us an email, thefinalbar@StockCharts.com, with any questions that you have about charting, technical analysis, our platform, market history, whatever it is. Also on Twitter @FinalBarSCTV. Finally, on our YouTube channel, just put a comment below the video you're watching. We'll capture all those. We'll do another mailbag segment on Tuesday's show of this week. I thought that 87 crash little video presentation was really, really fun. It brought back, I mean, for me, now that we're not traveling, it brings back some great memories of traveling around with the StockCharts TV team and capturing some of those really cool discussions. But I thought with Al Brooks, with Fred Meisner, with Ralph Acampora, some really good experiences there. Our next segment is called Shifting Stocks. The idea here is, talk about macro picture, talk about some sector rotation, and get into individual stock ideas. For me, this sort of completes the weekly routine that I have. It starts on Thursdays and ends on Mondays, and really the Sunday into Monday for me is individual stocks, and I go through the entire S&P 500 chart by chart, try to review some of the signals that I'm seeing. So these are really, patterns and charts that caught my eye during that normal review process. We'll get through as many of these as we can. And to be honest with you, as I'm going through the show earlier and just going through the macro charts, a lot of similarities with what you're seeing on the S&P chart and a lot of individual charts. Stocks don't look bad, and there are very few charts that look horrible, and I would tell you they're mostly in the energy sector, maybe in financials. We've talked about the technical ugliness, for lack of a better word, of the energy sector. Again, there's very little in there to be excited about, especially in that large cap space. The average chart just looks really pretty bad. ConocoPhillips maybe comes to mind as a good example of that. But other than that, I mean, the average chart doesn't look that bad. They look okay. They're kind of coming off pretty extended levels, pretty high levels. And the question, as we've talked about, remains, is the S&P going to have enough gas in the tank to propel above 3,600 and push to new highs? Days like today make me feel that's less likely. And they talk about one of the things we've sort of reviewed is that, the trend overall has been positive. That doesn't mean that it can just persist, to infinity. There has to be some point where there's backing and filling. I think seasonally, and based on my conversations with the presidential cycle folks today, we might be seeing some of the seasonal weakness emerging today. The chart in Netflix maybe is a good example of that. You call that a triple top potentially. I'm noting the similar candle patterns here. And again, I'm using a bar chart, but candle chart's going to look pretty similar. These are called dark cloud cover. We have a big up day followed by a big down day. Day two doesn't close below the previous day's open, which would be a bearish engulfing pattern, but it closed at least 50% of the way through the first day's open to close range, or what you call the real body. So that's a dark cloud cover candle. You can also see the very similar pattern here about a week ago when you saw the Netflix threatening to go to a new closing high. We gap higher the next day, but then it closes down at least 50% of the way through. We've now followed through a couple further days to the downside. So now all of a sudden this is establishing a pretty key resistance level, really around 560 to 580. And, again, my concern with individual stocks is that they're all facing these key levels. They're facing huge resistance, just like the S&P's near 3,600. And you think about what it would take to propel stocks above there. I think with individual names, we're seeing about the same thing. Also noting on the Netflix chart, the weaker momentum every time we've pushed higher. So every time Netflix has attempted to regain those new highs, break to 580 and beyond, the RSI lower and lower. So overall less momentum in play there. Within consumer discretionary, we're going to jump around sectors here quite a bit. I hope that's okay. But GM comes to mind. When we think about automobiles, I immediately think of Tesla and looking at that chart. But I think it's worth noting the sort of traditional automakers also holding up pretty well. And the chart of GM isn't bad. It's actually a pretty decent chart at a time when other charts are struggling a little bit. GM outperformed today, just down about 1/3%, but making new relative highs today for the last 6 months, which is kind of impressive. Remaining above two moving averages, above the 50-day. It's had a couple pullbacks, but has resolved higher. Now it's arguably it's certainly a new closing high for the last stretch here, and trying to get above those September highs, but beginning to do so. Friday was really the big move where it closed new highs, another intraday high today. So overall, GM I think holding up very, very well. In terms of other charts, holding up pretty well. Costco maybe comes to mind. It was down today along with sort of everything else. I think the challenge for Costco is the trend has been positive. That's a thumbs up. Overall, the RSI remains in a bullish range. That's a thumbs up. That's a positive check in the positive column. The relative strength has continued to improve. Overall, that's pretty impressive. The concern now, a couple things. Number one, it's pretty far away from its 50-day moving average, pretty far away from its 200-day moving average. We have an ACP chart that allows us to do that. I won't show you that for the interest of time, but overall, when a stock fluctuates, when it's in a trend, it's going to sort of overshoot and undershoot the trajectory of that trend. Costco sort of giving the signal that it's at the upper end of that range if you look at the last 6 months, and that's okay. Overall, that trend can remain positive. It may suggest a little bit of short-term weakness, and I think that's also, if you look at the RSI and when it's become overbought, especially in the last 4 months, that's been sort of the buyable pullback, sort of builds up momentum for the next upswing. I wonder if that's what we're starting to see the beginning of. So overall, I like the chart. I think the chart overall setting up well for the long term, but in the short term, feeling a little extended, like it might pull off a little bit. Within consumer staples, there are some charts that don't look nearly as good. The tobacco makers come to mind. Altria, maybe MO, had traded above its 50-day moving average in September, broke below its 50 and its 200-day. Kind of came back up to it, and it felt like this was regaining steam, but now it's failed at its 50-day. It's now back below the 200-day, so it's below two downward sloping moving averages. On the last upswing, the RSI didn't get above 60, and the relative strength close to making another new 12-month low after doing so, relative low after doing so last week. So overall, that's actually setting up a little weaker than the average chart for sure. Within industrials, in terms of something that looks different, GE comes to mind as a stock that's, while so many stocks are sort of in a position of strength, a long-term uptrend and potentially rotating lower, GE is actually the opposite, has been in a distribution phase, really a consolidation phase for the last 6 months. If you look at it, in a price basis, not really moving anywhere. Relative strength overall has been in a downtrend because stocks have been rallying while this has been sort of stagnating, but has bounced off of the support level around 6 for a number of times, now making a new swing high for the first time in quite a while, getting above getting to a 7 handle, which is an improvement from where it's been historically, just at that overbought range. So I think nearing the 200-day, nearing previous resistance is a bit of a concern, but overall setting up nicely and flat for the day on a day when the average stock was down. Now, talking about the average stock being down, I'll talk a bit to wrap up here about technology. The chart of the S&P concerns me in that we have established potentially a lower high here. The chart of Apple sort of lines up with that pretty well. You can see how much weaker the momentum is. The RSI really didn't get above 60 this time around, back below the 50-day today, really establishing a lower high. And I'm concerned that on a longer-term basis, this could be the beginning of a rotation lower. The way you confirm that is by breaking below this swing low. So really we need to get below 105 before I would start telling you this is going to get a lot worse. I think at this point, it's more of the backing and filling type of feel where the trend still overall could be positive, and now it's just telling you a bit of short-term weakness. But the lower high there is certainly a bit of a concern. Now, having said that, you're going to find that on charts like MasterCard, MA. You're going to see that obviously on Visa, which is a very similar chart in a similar group, making a new 10-month relative low over the last week. PayPal, this is all in that same sort of payment processing group. Not as bad of a lower peak, but still establishes maybe even more like a Netflix-y kind of triple top type of pattern. But again, just confirming the overhead resistance and the magnitude of what we need to eclipse to move to new highs. NVIDIA within semiconductors with the lower high. So I'm concerned about some of the things that I'm seeing there. So what is not has actually been able to break to new highs, something like Texas Instruments. What concerns me there is now you have a bearish divergence where you have higher highs in price and lower peaks in the RSI. So again, I'm seeing a lot of these patterns on the longer term charts telling me the trend overall has been fine. The trend on TXN still remains very positive. I wouldn't be surprised if this long-term trend of price and relative performance persists. But what it is telling me is that we're a little overextended and we need to pull back a little bit. And I think that's lining up with sort of the next couple of weeks being weaker rather than stronger as we back and fill. And then the question is, do charts like this hold 135? Do they hold the 50-day? Does the S&P hold 3,200? Those will be the questions we have to grasp over the next couple of weeks or so. That is our segment, Shifting Stocks. Really touched on a bunch of different things, but the overall theme being the lower highs and the potential weaker momentum we're seeing at the individual stock level. We need to wrap the show. Go to the 3 and 3 charts. 3 minutes. Here we go. Chart number 1 is the consumer discretionary sector. We didn't get too much into the sector rotation work today, but again, the chart of the XLY reminds me of some of these other charts we looked at, especially in tech. Higher highs in the XLY, really unable to close and follow through above that September peak, but we're seeing weaker momentum and a real lower high in the RSI. That's a bearish divergence, speaks to lower weakness, and again, support around 140 on the XLY if we would start to sell off. Chart number 2 is Netflix. I think the triple top in Netflix, potentially some of the other charts we looked at, is a potential area of concern. Stocks like Netflix, sort of a big bellwether, we're all at home type of name, struggling to get above previous resistance, does not make me feel great about the potential for meaningful upside from here. It's not bad. It's not the end of the world, but it's certainly maybe the end of excessive uptrends. Finally, the chart of GM, if you're looking for outliers, there are stocks that are starting to break out. There are stocks that are holding up, that are up on down days. You just have to know where to look for them. And again, I think charts are a really good way of trying to identify those opportunities. Look for those stocks that are able to hold up and break out on days when the market overall is weaker rather than stronger. Folks, that is our show for today. Thank you so much for joining us. As a reminder, we did our presidential cycle panel earlier today. Just showed on StockCharts TV this afternoon. If you missed it, go to our YouTube channel and check it out. It was a really cool conversation with Bruce Frazier, with Jeff Hirsch, and with Tom McClellan. As a reminder, we're going to do another mailbag segment on tomorrow's show on Tuesday and again on Friday. So if you have any questions, shoot us an email, thefinalbar@stockcharts.com, or on Twitter @finalbarsctv. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.